For years, I've studied financial crises, the crashes, the panics, the slow burns that turn into infernos. And every time I look at the year 2026, I feel the same cold pressure in my chest. Not because the world is about to end, but because most people are looking in the completely wrong direction. Whenever trouble brews, our eyes go straight to the usual suspects: Wall Street, stock tickers, bank earnings, housing prices. But history teaches us that financial disasters rarely begin where the headlines are pointing. They start quietly, structurally, almost invisibly. By the time the markets finally notice, the damage is already done. And when I look at the world today, I can't escape the feeling that 2026 will not look like 2008 or 2001 or even the early 90s. It will be something new, something global, and something driven by forces that are already in motion. The real question isn't whether turmoil is coming, it's whether you understand where it's coming from and if you're prepared for what happens next. To understand why the warning signs for 2026 feel so different, I often think back to 2008. That was the year that reshaped an entire generation's relationship with money. In 2008, the crisis had a clear face: subprime mortgages. It had villains, predatory lenders, and Wall Street quants. It had a trigger: a housing bubble inflated by toxic private debt. The crisis spread through the banking system like a virus because everyday people were drowning in loans they could never repay. It was a crisis rooted in households, mortgages, and private leverage. But the world we live in today is built on a totally different foundation. Today, households are not the pressure point. Governments and corporations are. Public debt is at levels no modern economy has ever carried outside of a major war. Corporate debt, especially in America and Europe, is stacked on a mountain of low-interest loans taken out during the ultra-cheap money era between 2010 and 2021. Well, that cheap era is now gone. Interest rates are higher. The windows for refinancing are closing, and a massive wave of debt, some of it too large to roll over, is coming due in 2025, 2026, and 2027. That is why 2026 feels like a ticking clock. Because unlike 2008, this time the danger isn't coming from households. It's coming from the lenders, governments, and corporations that once looked invincible. I often compare this setup to the early 1990s recession, a crisis that many people have forgotten. That recession wasn't caused by households, but by institutions. It was the savings and loans crisis. Thousands of banks failed because high interest rates collided with their bad balance sheets. It wasn't a bubble that bursted. It was a foundation that cracked, and that foundation cracked because the cost of money changed almost overnight. The exact same shift is happening today. But the scale is bigger, the players are larger, and the global economy is far more interconnected. To understand why this is so dangerous, you have to look at the math behind modern corporations. During the zero-interest era, companies refinanced everything: long-term debt, short-term debt, debt for expansion. They borrowed because borrowing was practically free. Investors actually pushed them to take on more leverage because higher leverage meant higher returns. From tech startups to real estate giants to manufacturing firms, leverage became normal, even expected. But when interest rates rose, the debt remained. And in 2026, much of that debt must be refinanced at rates 2, 3, or even 4 times higher than when it was first issued. What was once a manageable payment becomes a serious threat. What was once a profitable company becomes a huge risk. Most people don't realize how many companies have been just barely surviving thanks to these refinancing windows. That window begins to close in 2026. And when it closes, companies don't just default immediately. It's a slower process. They freeze hiring. They cut investments. They start layoffs. Then credit markets tighten. Consumers slow their spending. And before anyone really notices, a recession begins this time, starting from the corporate level and spreading outward. This is precisely why 2026 will look nothing like 2008. Because 2008 was a bottom-up crisis. But 2026 is shaping up to be a top-down crisis. The historical comparison I keep returning to is the 2001 recession, the bursting of the dot-com bubble. That crisis wasn't about banks or households either. It was about overvalued corporate assets, overborrowed companies, and an economic shift from irrational optimism to harsh reality. In 2001, entire sectors collapsed because their valuations were based on fantasy. In 2026, companies may collapse because their balance sheets simply cannot survive the new cost of capital. In 2001, businesses failed because they were unprofitable. In 2026, businesses may fail even if they're profitable, simply because they cannot refinance their debt. When I talk about 2026 being a bloodbath, I'm not talking about markets falling 50%. Crashes come and go. What really matters is the structure underneath the crash. And the structure we have now is fragile in ways most people cannot see. Governments are carrying record deficits. Corporations are carrying record debt. Central banks are trapped between fighting inflation and maintaining stability. The margin for error is razor thin. And the same institutions that saved us in 2008 now have less room, less ammunition, and less political freedom to intervene again. Yet, despite all of this, I'm not pessimistic, because the point of understanding a crisis is not to fear it, but to prepare for it. Every major downturn creates winners and losers. In 2001, tech collapsed, but cloud computing, software, and data companies emerged stronger than ever. In 2008, banks suffered, but fintech, e-commerce, and mobile technology transformed the world. The question is not whether 2026 will bring pain. It will. The question is whether you position yourself on the right side of that pain. And that is where the most important insight comes in. If you want to survive 2026, you must stop thinking like it. As 2008, you must stop waiting for the housing market to collapse or for banks to implode. Instead, you must pay attention to the sectors most exposed to refinancing risk, the industries most vulnerable to higher for longer interest rates, and the governments that are struggling to service their record deficits. This is where the real opportunity lies. Companies with low debt, strong cash flow, and real pricing power will not just survive, they will dominate. Industries that are insulated from interest rate pressure, like energy, essential services, critical infrastructure, and certain forms of technology, will form the backbone of the new economy. Investors who understand this will shift their strategies early, quietly, and confidently. Those who cling to the old narratives, expecting a replay of 2008, will miss the real story. Because 2026 will not be a housing crisis or a banking crisis or a stock market bubble bursting. It will be a structural reset, or fundamental correction in how the world prices money, debt, and risk. And after every reset, a new economic hierarchy emerges. This is why I say 2026 will be a bloodbath. Lest you do one thing, stop preparing for the last crisis and start preparing for the next one. Thanks for watching. If this gave you a new perspective, make sure to like and subscribe for more insights on how to navigate the changing economy.